Target is one of the most recognizable brands in the world, and whether you know them for their overpriced items, white women shopping there every Saturday, or the recent drama that they stirred up with the LGBT community, Target is the 13th largest retailer by market cap and is a company that is hated by many and loved by many amongst the investing community. Target is also a company that I've been known to talk about on this channel and a company that I've been putting my own money in. So today I will be explaining everything that you need to know before investing into Target, the good stuff and the bad stuff, and going into an in-depth analysis of Target's business model, financials, and so much more. And if you hate when companies get involved with politics as much as I do, hit that subscribe button for me. On this channel, we promote real man's investing, actually looking at businesses itself. Alright, with all that out of the way, roll the intro.
Hello, I like money.
To start off, we're just going to talk about what Target is if you don't know already, and Target's history a little bit. Target is a general merchandise store. Really, you can go to Target and find anything you need, really, whether it be groceries, more discretionary items, furniture. It's really a general retail store. Target's demographic is definitely targeted more towards, middle and upper class people. And another retailer like Walmart is definitely more appealing to all demographics rather than Target's more upper class. 75% of the US population lives within 10 miles of a Target store. Target employs over 400,000 people. Their CEO is Brian Cornell, which we'll get into later. Target's first official store opened in 1962 under the Dayton Company in Minneapolis, Minnesota. Last year, Target had $109 billion in annual revenue, which equated to about $5 billion in free cash flow, which is one of the most important metrics when actually looking at how much a company's making. Target has 1,959 stores in the United States, with very little international stores as well. Target has 57 supply chain facilities, 30 office locations globally. They invest 5% of their profits go back into their own communities that they're in. Target is also ramping up their in-house brands with over 45 in-house brands and owned brands unique to Target. Big thing to note here is that Target is really strictly a US-based company with not a lot of international growth, so if you're looking for that, that's not the company you're going to. Target has a very long history dating back to 1902, and I'm going to brief it up for you guys real quick. Essentially, George Dayton came up with an initial store in 1902. This was later on from 1902 to 1968 branded the Dayton Company. This was just a general retail store. They sold items during the wars. George Dayton merged with other various retailers to form up the Target Corporation that we all know today. This rebranding happened in 1968, and eventually Target started to grow and really utilize their brand. Target's initial stores were in Minneapolis, Minnesota, but eventually throughout the late 60s and early 70s, they started to expand across North America. In 1979, Target got their first $1 billion in sales. In 1989, Target had 400 stores across North America and really continued to build their brand. Throughout the 2000s, Target really established to be a retailer where you can get anything at, whether it be electronics, Starbucks. Target was a place where you can go and get any good that you desired. During this time, they really built up their brand, and being a retailer where it would be a clean store you can go to, where it's a safe place to shop. This differentiated them from a place like Walmart, where you may see some interesting people. Now let's talk about CEO Brian Cornell. Brian Cornell was hired in 2014. He was hired by Target as a strategic decision that built on the company's strengths as a multi-category mass merchandiser with excellent reputation for shopping experience, brand curation, and brand development. Brian has led a lot of investments in wages, benefits, team training and development, and diversity amongst their Target team members. This is a big thing for Target too that I think separates them from another retailer like possibly Walmart, which is happier employees. Target has very strong benefits for their employees, good pay, etc. Prior to joining Target, Cornell spent more than 30 years escalating leadership positions in leading retail and consumer product companies. Cornell is also heavily involved with a lot of African American rights, history, and a bunch of diversity things too, which is good to see. During the 9 years of Brian Cornell's current tenure, the stock price is up 108%. Now, if we divide that by 9, we get an annualized 12% return through capital appreciation. That doesn't include dividends either. And that includes the recent huge dip that Target has had on their stock price too. I'm a big Brian Cornell fan personally. I think he's a very well-spoken CEO and very calm during quote-unquote tough times. Here's an interview from CNBC right after the company had a bad earnings report.
Quarter. What happened?
Well, first of all, Becky, I appreciate being here during a difficult report.
Right.
But it's a chance to talk about kind of our business and where things stand. And I frame it by really looking at kind of the front of the house of our business and then the back of the house. And if I think about the front of the house, the consumer guest-facing component, we saw really strong comps, over 3% on top of 23% last year. And importantly, it was driven by traffic. Traffic up 4%. on top of 17% last year. Guests are shopping our stores, they're enjoying our services, they're using Drive Up. But clearly, the challenge for us in this quarter was the back of house. From a freight and transportation standpoint, things have changed significantly from even 13 weeks ago. I did not project the kind of significant increases we would see in freight and transportation costs. And you've been talking about it on CNBC almost every day. I think yet again this morning you talked about all-time record fuel and diesel costs. Right now we project that's going to hit us about $1 billion of incremental costs in this fiscal year. So a significant increase that we didn't anticipate. The other change is in our category mix. While our comps grew by 3.3%, pretty balanced between digital and stores, we added another $1 billion in incremental growth in the quarter. The mix of the categories looked very different than we expected.
Big thing I took away from this, even with all the bad news and all the systematic issues that they were dealing with, Cornell still seemed very optimistic about the other business segments that they saw growth in. I like an optimist and CEO. I don't want somebody who feeds into the negativity, and I want somebody who focuses on the positives with acknowledging the negatives, and that's what I saw from Cornell there. Cornell's also been CEO during a time of a lot of buybacks and a lot of dividend increases, which we'll get into. Currently, Target is trading $132.26. The company was trading at $250 just 3 years ago. Crazy how fast things can change. Over the last year, Target is down 20%. The main reason for this huge dip is mainly due to the controversy over the LGBT situation, where eventually they had a big screw up. I'll be honest, they had a big screw up there. From my indication, they've learned from the mistake and they won't do it again, obviously, as they're down 20% as a result. During this time, though, I would like to see them buying back shares, as I do think fundamentally they are undervalued, as we'll get into. Over the last 5 years, Target stock is up 60.67%, regardless of the recent dips. And over the last 10 years, Target stock is up 85.87%, not including dividends. Now let's take a dive into Target's financials. Currently, they're trading at a $61.17 billion market cap. They have a price-to-sales ratio of 0.62% with a price-to-book ratio of 6.37%. They have a free cash flow yield of 0.81%. The free cash flow yield right now is lower, as they are in a lower time of free cash flow, which I'll get into. Their profit margins are very slim, as they are a retailer, and they always got to lower prices to compete. And right now, they are in a cyclical time of people are not buying the more profitable items for them. They're buying more the necessities that are the lower profit items. Right now, they have $16.01 billion worth of debt. Now, this really isn't a concern for me, as they are still building new stores, doing capital expenditures, etc. It's really not a red flag if you look into it a little bit. Target has very quality revenue growth recently, with just consistent revenue growth, but obviously you guys know on this channel that free cash flow is the ultimate metric to see how much a company's raking in, and for Target right now, it doesn't look so good. We need to do a deeper dive into that, though. Taking a look at Target's free cash flow, we can see that there's been a 129% dip in the most recent year. We obviously need to do a lot more research. We need to understand first what really eats away at free cash flow. To start off, especially for retailers, inventory shrinkage is the big thing there. Stock-based compensation also, but Target stock-based compensation really does not eat up a large majority of their free cash flow. Their stock-based compensation literally makes up nothing looking back at their previous years of free cash flow, so that's not it either. And the other thing is capital expenditures, guys. We need to understand, looking at Target's free cash flow, they had a big 2021, big 2020. Obviously, Target is going to be taking those record profits and paying it back in the form of huge dividends and reinvesting back into their business through capital expenditures so they can continue their earning power and continue making more money in the future. We could take a look at Target's capital expenditures. They spent pretty much a record $5.53 billion this year so far. Keep in mind, we're halfway through 2023. They're still spending. They spent $5.53 billion in capital expenditures, and from what I'm seeing, that's pretty much the main reason that the free cash flow is down right now. But another thing to keep in mind really is shrinkage as well. That's another thing that's really hurting them, and we're going to talk about that right now. So real quick, if Target didn't want to do any capital expenditures, they didn't want to grow their business at all, do the good thing with the money that they had from 2021, their free cash flow would be at $4 billion right now. Moving on to shrinkage, though. Shrinkage is an issue that all retailers have been dealing with, especially in the last few years as well. It's basically the undocumented loss of basically inventory. You don't know where inventory's gone. It could be rather employees stealing it, it can be theft, or whatever reason. The main one is really just crime. Target said that last year retail crime caused them to lose over $400 million in profit. That's obviously a huge issue right now. It's really just a systematic issue overall, but it's impacting all retailers negatively. Despite that, though, Target is still seeing growth year over year and increased traffic. Now, how are they dealing with shrinkage? What are they doing to prevent these theft, the crimes, etc.? Target is investing in a facial recognition software to help identify these thugs and hoodlums going into their stores. They're also investing into more security cameras. Overall, really just trying to make their stores more bulletproof to crime. Target is also investing into asset protection security offers. These are basically the police academy rejects that aren't in the police just yet, but they still do have power. They have a taser or something to prevent thieves. They're also hiring more security officers as well and more crime-ridden stores. So obviously Target is taking a lot of measures to prevent this, and this obviously is taking a toll on their capital expenditures right now. Another thing that sucks as well is the law literally prohibits you from chasing these thieves after they take something. You can't chase them out in the parking lot or whatever, which is really stupid. Target is also combating this by closing stores in these crime-ridden areas. Now, fake news like the New York Times are calling out Target and saying that it's racist and all, that it's showing lack of pledge to black communities. Well, at the end of the day, why would Target want to open a store there if they're literally losing money? It doesn't make sense business. It doesn't make sense qualitatively wise either. Right now, Target's dividend is trading an attractive 3.32% yield, which is typically higher than it usually trades. Usually it's 2.5 to maybe 3% on the high side. Right now, you'll see that their cash dividend payout ratio says it's at 73.59%, but taking a look at the cash flow payout ratio down below, it's a healthy 26.02%. Now, obviously, Target is allocating more money, hopefully towards buybacks right now as the stock price is lower, and those capital expenditures. The recent dividend hike was 0.8%, which is much lower than the last one, which is around 20%. People are really saddened by this lower dividend hike, but obviously during a time like this where they have to deal with other things such as capital expenditures, it was the responsible thing for the company to do. If they would have hiked their dividend maybe 12% again, yeah, it looks nice on paper, but their dividend would have been in jeopardy. It would have been the irresponsible thing to do for the growth of their business long term. Moving on more about Target's dividend growth. Target has a 1-year dividend growth rate of 22.22%, but keep in mind that recent hike was very small, 0.8%. They have a 2-year dividend growth rate of 27.19%, a 5-year dividend growth rate of 12.15%, and a 10-year dividend growth rate of 11.82%. Now keep in mind, Target is a very, very cyclical business. When times are great in the United States, everybody wants to own this stock. They're pumping out free cash flow, giving out 20% dividend hikes left and right. This is a business that you want to own long term through the good times and the bad. Ideally, right now, when times don't look so great for Target, you want to buy, get your cost per share down, your yield on cost up. Some years there will be 5% hikes. Some years there will be 50% hikes. Some years there will be 1% hikes. Over time, you're hoping for that to average out to a very solid dividend growth rate. Now, a thing that I'd like to see when a company is trading fundamentally undervalued, when I believe, is share buybacks, and that's exactly what Target is doing. Over the last 1 year, Target has bought back 5.68% of their shares. Over the last 5 years, they've averaged buying back 3.34% of their shares. And over the last 10 years, they've averaged buying back 3.5% of their shares. This is something great to see, especially right now. When buybacks happen, you own more of the company, you get more equity, which is a great thing to see. Target's earnings per share has been a lot more slow growing than some of the other fundamentals that we've looked at and the other metrics. They have a 5-year earnings per share growth rate of 2.48% and a 10-year growth rate of 2.84%, with recent declines, obviously, as they had that huge year in 2021 and 2022. Now let's take a look at a few different valuation metrics to determine what I think Target's fair price is. Keep in mind this was a company that was trading at $250 just 2.5 years ago. Currently, they're trading at a forward P/E ratio of 16.36, which is a 13% difference from the sector median. For a company like Target, I believe they should be trading in the P/E range from 18 to 22 forward P/E. They have a price to sales ratio of 0.56, which is nearly a 50% difference in their sector median. So looking at the price to sales, that looks undervalued as well. Now let's find Target's value with the dividend discount model. And currently looking at Target's value, we can see that they have a dividend discount model valuation of $148.40, which is about $15 above where they're currently trading. Big thing with dividend discount model, it is really a metric of how the dividend has been performing as of recently, and obviously that recent dividend hike, which was much lower, will kind of hurt that valuation a little bit. Now let's take a look and see what the real professionals, the analysts, are saying, which is just kind of a good third opinion. They kind of track the stock more closer, some of the more inside things that us retail investors don't have access to. we can see that they currently have 13 ratings to buy Target and 13 ratings to hold Target, with the highest price target being at $220, the average price target being at $174, and the lowest price target being where it is now at $130. What do I personally think though? I think Target is fairly priced at $160 to $190. They had a correction about a year ago, which was actually from the CNBC interview when they fell 20%. The recent bad news and controversy really is just driving the stock to fall an extra 20% from that correction. We can also see here that Target's return on capital employed, which is a metric of how much their investment in those capital expenditures really pay back at the end of the day, and they have a very solid return on capital employed right now at a low, for them at least, 11.37%. Right now is at a time where Target's at a low when it comes to like profitability, operating margin, because people aren't buying those higher profitable items. People have less to spend right now. So what are my final thoughts on Target stock? Target is a very cyclical business, and they are an American-based business. My investment thesis on Target is the American economy continues to grow. Over the long term, Target will follow. Target is a business that you ideally want to buy in times like this when not a lot of people are believing in the American economy. There's a lot of panic, a lot of worry, and the stock is selling off. Long term, I believe Target will be a good holding. This is ideally, as I mentioned, a company that you want to buy during the low times. Target may not be an Apple or a Microsoft, but I believe that they'll be a staple. And right now, I am buying Target at these current prices. Again, I'm not a financial advisor or anything. They take this as entertainment and education only. Alright guys, and that's the video. I hope you found it informal. I'm very happy with the way this one went. I believe it is one of the highest quality videos that I've made on this channel's history so far. And Target's just a business that I feel I really do understand. With that said, if you haven't already and you're already here, make sure to subscribe, join the Discord link in the description, and of course, smash the like button. Thank you for watching. It really does mean a lot. And of course, do dividend stocks, not drugs. Have a good one.